Okay, good afternoon. Thank you for coming to our analyst. Moving to our results. So we ended last year with 26.1 billion. It's a 4% growth compared to last year. And if we're to look at components, income from loans and receivables up about 15%, more or less tracking the growth in our loan portfolio. Overall net interest income was up a little over 15%. Fee income showing we had a good year last year, and we ended with a 15% growth, and that's excluding the contribution from the insurance side. Trading and FX, as expected, with rates starting to firm up, we saw a substantial decline in our trading and FX gains last year by about a third. Operating expenses, the headline number is a 27% increase, but again, this includes the insurance and rural banking subsidiaries. So with that, we saw PPOP increasing by 10% year on year. Moving to the balance sheet, our loans up 16% year on year. Deposits were up 15%, but all of it actually came from CASA growth, which was up 21.5% year on year. So we were able to keep time deposit levels flat or even slightly lower compared to last year. On the deposits, as I mentioned earlier, CASA was the main contributor to our deposit growth, and we ended with a 73% CASA ratio, and that has helped bring down our cost of deposits down further to 77 basis points. So net interest income up 15%, higher than last year's growth of 11%. On the fee income side, again, looking at growth, we saw good growth last year at 15%. So in terms of components of operating income, we're still maintaining over 80% of our operating income from recurring sources. In terms of asset quality, 1.3%, but coverage we think is still the highest among peer group at 139%. So in terms of provisions, we set aside 3.8 billion last year. And lastly, in terms of capital, with the first installment of the DSIB took effect this year. So this is how we ended based on the fourth quarter last year. So net income, historically, this is how it's progressed. So it's a historical high again for us. Just quick updates on our initiatives in terms of ONB. So as mentioned earlier, the branch network now of ONB is 125, but I think the main difference is we've added branches in Luzon and more in the Visayas. When we acquired ONB, they only had about 5 branches in the Visayas. So now there's 16, and in Luzon we have 6. On the life insurance side, we ended last year number 8 in terms of total premiums, but in terms of traditional life insurance, we're now actually the 3rd largest. Also, for the retail trading platform, we launched it late October last year. So we now have another channel by which our clients can access the equities market without having to go to a BDO branch. That's the end of our presentation. I'd like to open the floor to any questions.
Can I just ask one more question about wider on loan yields? You commented that obviously asset yields remained, they were flattish to down a couple of basis points, I guess, over the last 3 quarters. But I guess, if we look at the different growth rates of your loan book, your asset mix, I guess should have been positive from a pricing point of view. So how much pricing power do you actually have on individual lending categories at the moment?
It's still a very competitive market.
On the consumer lending side, it's relatively stable. everybody's bunched around the same rates, so there's really no reason for us to upset that. It's in the middle market that we do have some pricing power, and it's because they're not as planned as the other two.
Okay, thank you.
Any risks to NPL, especially that you're focusing on the middle market and consumer segments, amid the rising interest rate environment? Plus, how much impact would the new BSP definitions and PFRS 9 on the NPL ratios?
We're still assessing the impact of the new NPL definition of the central bank. Any other questions? If there are none, then I guess we can wait for lunch. Please, thank you.